Let's get into the advisory now. And should one be taking super death benefits as a lump sum or as an income stream? Andrew Grinsell from Cooee Wealth joins me. Andrew, great to have you with us here on Ausbiz.
Thank you for having me.
First, let's take a step back. What are super death benefits?
So super death benefits are a payment made to a beneficiary on the death of a super member. So when someone passes away and they've got a superannuation account, and that then needs to be paid out to a beneficiary.
Okay, so going to whether or not you should get it as a lump sum or in smaller amounts, what's the best advice here?
Really depends on the circumstances of the individual, and a lot of this needs to really be planned for upfront. So that means doing it at the time of doing your estate planning. Now, if someone's got large debts, home mortgage, other expenses that need to be paid off, sure, taking the lump sum might be the most appropriate option. But for people who are actually looking to get that paid out or need an income stream, maybe taking it as a pension can be more beneficial. The issue is that if you go and take it as a lump sum, it can actually be very hard to get that money back into superannuation afterwards due to the superannuation contribution caps and age-based restrictions.
So that was what I was going to ask. Can you actually funnel it into your own super account, or does it remain in a separate account?
It remains as a standalone account, however it's under the control of the beneficiary. So it's in their name, it just can't be merged in with their existing super benefits. So it is a distinct death benefit pension.
All right, so when you talk about tax effective moves, I know this is going to be on an individual basis, but what are you seeing as the most tax effective way to deal with this?
Yeah, so for people with larger superannuation death benefits, having that money retained in super, especially if either the deceased or their beneficiary, and the beneficiary does need to be a spouse or a financially dependent child for the pension to work, but if it's a larger balance, keeping it inside the super environment and paying it as a pension can be more tax effective, because you do benefit from no tax on the investment earnings and also no tax on the pension payments, subject to the transfer balance cap and some other restrictions, and also Div 296. Whereas if that money comes out of the superannuation environment, it's then going to be taxed if it's invested, and it'll be taxed at marginal tax rates, which can end up being quite a lot higher. We recently had a client with about a $1.8 million superannuation death benefit. Had that been paid out to her, she would have paid about an extra $47,000 a year in tax. Over 10 years, it's close to $500,000, keeping it in the super environment tax-free. So obviously more effective.
Sounding like actually getting some advice is worth it.
Yeah, absolutely. And the best time to get that advice, I'd say, is actually upfront when doing the estate plan, because it can become a little bit more restricted if we're trying to handle it later on, at the time of the member's death. We can have fewer options available to us.
And I guess a lot of emotion at that time as well. Now, you touched on Division 296. This is very contentious. How are you dealing with all the questions surrounding this?
Yeah, I think the best thing for anyone to do is actually take a step back and really understand how it's going to impact them, and really understand what the correct determination of the proposed rules are. We've got to remember, this isn't yet legislated, but based on our understanding of it, we need to make sure that the misconceptions are avoided. So there's a lot of talk about it being a 30% tax on super benefits over $3 million. It's an additional 15% tax on top of the existing rules. Yes, there's tax on unrealised capital gains. That is obviously an issue, but again, it's 15%. It's not 30% like some people are understanding it to be. The other point that probably needs to be clarified is it's only on the proportion of the earnings that support the member balance above the $3 million cap. It's not on the entirety of the superannuation balance that Div 296 applies.
But the fact that it doesn't seem to be indexed towards inflation, isn't that going to affect more people than what the government is saying?
Yes, it absolutely will over time.
So how do young people or people in the midst of their careers sort of come around this? What is your advice in terms of protecting your super, building to it, but also making sure you're not in that position? Yeah,
I think one of the things is, it's a nice problem to have if you get there, right? So trying to avoid accumulating that much superannuation might not be the best thing. There are other ways as well to try and manage it. So sometimes what we're seeing with our projections is, with a couple, maybe one member of the couple is going to get to that $3 million level, whereas another member of the couple may not. So we start to look at things like spouse contribution splitting to actually even up the balances, because it's $3 million per person. We can look at that. Then also for people who are maybe over the age of 60 or 65 and retired, what we start to have a look at is withdrawal and recontribution strategies as well. So we might take a little bit of that excess out of the higher super balance with one of the spouses and withdraw that and actually recontribute it to their spouse who might not have as much money in super. So there's strategies that we can use to minimise the impact. Then what we need to also have a look at is, even if you are going to incur this tax, is it still beneficial to stay in superannuation, or are there more tax effective options elsewhere for you? And that might be investing personally, it could be looking at things like investment bonds, family trusts, but in a lot of cases, even with the additional Div 296 tax, superannuation can still be highly tax effective.
And for those that may not have reached the 500,000 contribution, almost the end of tax year, what's the best way to sort of maximise here?
Yeah, so we certainly are having a look at using carry forward unused concessional contributions for clients. We just need to obviously make sure that there is a tax benefit in doing so, and it really is just very much a case by case basis. Definitely helps for people who have had large capital gains tax events or bonus payments throughout the year. There's definitely opportunity there as well.
And just because it is your first time on Ausbiz, tell us a little bit about Cooee Wealth.
Yeah, so Cooee Wealth Partners is part of the Cooee Group. So beyond the financial planning business, which is Cooee Wealth Partners, we have mortgages, accounting, and also our property side of the business. So we're a diversified financial services business. We are very much focused on strategy first for clients and making sure that really all the right steps are being taken to give our clients the best opportunity to achieve their goals.
And are you seeing more Australians come looking for financial advice? Because there's some stark, horrible stat that only 1 in 10 Australians gets financial advice.
Yeah, certainly we're seeing a lot of demand, and I think when things are in the press around things like Div 296 and its complexity that comes with it, more people are inclined to reach out for advice around that. We're seeing a lot of younger Australians, so we do deal with a lot of people in their 30s and 40s who maybe traditionally weren't the main recipients of financial advice, now reaching out for financial advice.